bringing in Peter Schiff from Euro-Pacific Capital, always a great friend of ours on the show. Peter, last time we spoke, you said the Fed rate hike was going to be disastrous for the market. We have been down about 8% since that rate hike, but certainly other factors out there have impacted the action that we're seeing, China being one of them. Want to get your take on what's happening now?
Well, I don't think what's happening in China is the reason for the market decline. I think the reason the market is going down is because the Fed pricked the bubble. The Fed raised rates. Now, you can claim that one of the reasons that the Chinese market is selling off is because of what the Fed did. All of these problems are emanating from the Fed, yet we're trying to rationalize it by trying to pretend that what's happening in the U.S. stock market has to do with factors beyond our control. And I think that is a way to rationalize what's happening so that people can continue with this narrative that everything is fine, that the Fed we have a legitimate recovery, that the Fed can continue to raise interest rates and everything is going to be great, when all we had was a bubble and all the problems that everybody believes were solved have actually been exacerbated during the 7 years of 0% interest rates and quantitative easing. And so now the Great Recession of 2008 is going to resume in earnest because the problems are bigger than ever. And I think the market can continue to be under some pressure until the Fed rescues it. You know, Bullard just threw it a bone this morning. That might be why we're having a rally today, by suggesting that oil prices being lower than he thought means that there won't be enough inflation. And so maybe the Fed should consider that when it hikes rates. I think this is meant to kind of placate the markets. You know, Bullard is the guy that saved the markets back in August of 08, last year, when he hinted QE4.
Right. Peter, let me ask you this and go back to the first point that you made, that the bubble was pricked by the Fed here and that the Fed has an impact on what's happening in China. Break that out for me a little bit more so the viewers really understand why the Fed has an impact on the negative sentiment that we've seen there.
Well, what's happening in China is you're having pressure on their currency, the yuan, because many other currencies have already dropped on anticipation of all these rate hikes that are never actually going to materialize. So it's the weakness in yuan that's causing the capital flight from the Chinese markets. But all of that is based on the Fed raising rates and the erroneous belief that a lot more rate hikes are going to follow, that this is going to be some kind of normal tightening cycle. It's not.
But is
it's
that an erroneous
belief?
Because even since the first hike, people have been discounting the fact that we're going to see 4 hikes this year. Nobody is saying that anymore.
Well, the Fed is still saying that, but I don't think that it's going to happen. And meanwhile, look at where the economy is. I mean, we could already be in a recession. The fourth quarter is going to be extremely weak. It'll probably be below 1%. It might even be negative. We'll see for the fourth quarter of last year. But for the first quarter of this year, there's a very good chance we're going to have a negative number. Look at how disastrous all the retail sales have been. Corporate earnings are declining. Many of these stocks are blowing up. Look at the transports. The Dow transports are down at close to 30%. I mean, this is the most economically sensitive average, and they should be benefiting from the cheap oil prices. Instead, the index is collapsing. People are whistling past the graveyard here. It's very reminiscent of after the NASDAQ bubble burst. Everybody said, oh, don't worry about that. It's confined. It's just one segment of the market. There's nothing to worry about. It's not going to affect the economy. They said the same thing in 2007, 2008, when the subprime bubble burst. Oh, don't worry about it. It's contained to subprime. It's just housing. It's not going to affect the economy. When people believe something that's false, they tend to hold on to those beliefs, and it takes a long time before they finally concede that what they were believing all along was not true.
Peter, how far do you think we could go down? As I mentioned, we're down about 8% since that last rate hike. 10% is where we start to consider it a correction, a bear market. What do you see happening this year in terms of a percentage basis, how much we can drop?
Well, you've already got, I think, more than 20% in the Russell 2000. And there are many individual stocks that are down a lot more than 20%. So you've got some of these stocks that kind of masking the weakness. But it all depends on the Fed's pain tolerance. The markets are going to drop until the Fed changes the game. So when is the Fed going to take away the rate hikes? When are they going to cut? When are they going to launch QE4? Because that's the only thing that's going to put a floor beneath the market, because the economy is going into recession. Corporate earnings are going to continue to fall. Why should the market not go up? The entire reason the market rallied was based on the Fed. I mean, they'll even admit this. They deliberately engineered a stock market rally to create a wealth effect. Well, that phony wealth caused the economy to do things that it shouldn't have done. People behaved in ways that they wouldn't have behaved had they not had all this phony wealth. Well, now that that phony wealth is disappearing, we have to basically correct all the damage. And so there's nothing really for the market to do to go down until the Fed comes back with more QE.
Brian, quick question for Peter.
Well, my question would be, Peter, we know that you love gold, obviously. But given all these circumstances that you're outlining here, where are you putting your money? Besides gold, where are you putting your money right now? Are you just standing on the sideline waiting for the Fed to do something, then you'll buy stocks? Or are you going into bonds right now? What are you doing with your money right now?
I'm still invested. I'm just not invested in the U.S. And obviously, the strength of the dollar is hurting the value of all of my international investments. But I am waiting for the Fed to capitulate, for the Fed to admit that the economy is weaker than they believed and that they're going to do more stimulus. And I believe that is going to be very good for the foreign investments that I'm holding. And yes, I do hold gold, and gold has risen somewhat since the Fed hiked rates, but it really hasn't risen that substantially because people still believe in the myth of this recovery. They still believe the U.S. economy is the cleanest dirty shirt in the hamper, and I don't think it's even close to being true. And I agree with your previous guests. I think people are overestimating the problems overseas. I think overseas economies are in much better shape than is generally perceived. And I think the single biggest thing undermining some of the overseas economies is the belief that the dollar is going to continue to rally, is the belief that the Fed is going to raise rates. Once they realize that that's not true and the dollar starts to fall, that's going to take a lot of pressure off these global economies. That's going to provide a lot of relief for those markets. And I think there's a lot of opportunities for profits once the story reverses.
You make a lot of good points here, but I want to go back to the Fed for a moment. If the scenario that you're laying out is accurate and it does actually happen and we see sort of a reversal from the Fed, when do you think that could happen? When are they going to sort of take that step back?
Well, it's hard to know. I mean, it seems to me that the only data that they seem to care about are the jobs data.
The job numbers,
we got another supposedly strong non-farm, but all the other economic data is lousy. So I don't know. Maybe we get a very weak jobs report in early February for January. I don't know. We're getting some more economic data tomorrow. Retail sales, I think, consumer confidence. There's some numbers coming out tomorrow that'll probably be bad. But so far, the Fed has not acknowledged any of the bad data. I think it's afraid to acknowledge it because it doesn't want to admit how bad the economy is because it's trying to create a false sense of confidence. But at some point, they're going to have to acknowledge the weakness that's there. And maybe it'll be with the jobs numbers.
Peter, you mentioned foreign investment. You mentioned investing abroad. What are some of the things that you like out there that you can recommend, or some of these strategies that you're employing?
Yeah, well, because the dollar has risen so much based on these false expectations, assets that I like in countries that are really in much better shape, whether it's in Singapore or whether it's in New Zealand or whether it's in Switzerland, there are quality assets that people can buy that generate substantial dividends in Swiss francs, in Kiwi dollars, in Singapore dollars that I believe are going to rise dramatically once the dollar turns. And I also believe that once people really perceive the gravity of the problems in the United States, that the United States will no longer be a safe haven, and money is going to flow into alternative safe haven markets. And I believe that the markets that I'm investing in are going to be the beneficiaries of those flows once perception changes. And I also think it's going to change for gold. I think when people realize the extent to which the dollar is going to decline and how much inflation is actually going to be created by the Federal Reserve, that the balance sheet is not going to shrink back down, it's going to explode out of control, it's going to be a game changer for gold as well.
All right, Peter, thank you for coming on. And we are very fair on this show. A little bit of a victory lap for Peter Schiff. And Peter is saying that things are going to get worse. So certainly we're going to be watching and see how to trade this as well. Peter, thanks, and we'll see you soon.